Good morning, good afternoon and good evening. I am Emma Joyce, Head of Community at Global Digital Finance, and it's my pleasure to welcome you to our inaugural Global Leaders Town Hall in partnership with the Global Blockchain Business Council, with special guest Professor Michael Mainelli today. Throughout this series over the coming months, we will be hosting weekly sessions with policymakers and business leaders to hear their insights into the emerging COVID-19 crisis and field questions from members of the community. Lawrence Wintermeyer, Board Co-Chair of GDF and GBBC UK Regional Ambassador, is hosting today's Town Hall from London, which is focused on the government and city's response to the crisis. Professor Michael Mainelli is the Executive Chairman of Z Yen Group, a qualified accountant, securities professional, computer specialist and management consultant, educated at Harvard University and Trinity College, Dublin. Michael gained his PhD at the London School of Economics, where he was also a visiting professor. His career spans aerospace and cartography science, accountancy firm partner, and director of Ministry of Defence Research. Michael founded and chairs ZN, the City of London's leading commercial think tank, famous for instrumental factor indices, including the Global Financial Centres Index and the Global Green Finance Index. Michael's clients include banks, insurers, asset managers, exchanges, policymakers, governments, technology and scientific firms and charities. Michael is Emeritus Professor, Fellow and Trustee at Gresham College, where he created the London Finance Initiative, asking, when would we know our financial system is working? I hope you enjoyed today's session, and I'd now like to welcome Lawrence and Michael.
Well, thank you very much, Emma. And Michael, always a pleasure to be speaking with you, particularly when we're asking the question about when do we know whether our financial system is working or not, which is part of today's questions. And so I'd like to hand over to you because ZYEN has last week launched two of its annual indexes. The first is the Financial Center Index, and the second is the Green Index. And so I was hoping we could pick that up as a context before we get into some of the questions about how governments are dealing with the C-19 crisis.
Okay. Well, Lawrence and Emma, thank you very much. It's a delight to be asked to hold forth a little bit in your first town hall. I think that's a great idea, particularly as we've got the coronavirus lockdown, to get some of us just chatting and talking for a change to each other. And I'm delighted that you decided to feature some of the work that we're doing. I took the liberty, as both of you know, of just setting out a light agenda. So I will, Larry, talk very much about the global financial indices, both competitiveness of financial centers and green. And then I think you and I would like to cover the coronavirus itself, what are its implications, and what's possibly going to happen in financial centers as we go ahead and look at the sector. So we'll come on to that in a moment. But as you say, just to provide a bit of context, we've been running these indices for a number of years. They began back in roughly 2003 when we began working with the City of London Corporation on how we could evaluate the City of London against a variety of centers. Initially, the corporation had done work in 2002 on something called Sizing Up the City, and they looked then in 2002, 18 years ago, at all of the competitors that London faced, every last one of them, New York, Frankfurt, Paris. Oh, I finished. Yes, that was it. And that was actually what the study looked at. And at the time, I thought that was a bit derogatory to all the centers I knew, Tokyo, Hong Kong, Singapore, many, many centers out there. And so we came up with this idea of running indices. We've been doing it, publishing them since 2007. They're published twice a year, so we have a March edition and a September edition. And GFCI, as we term it, the Global Financial Centers Index, is very much the sort of the granddaddy of them. There are a number of other indices out there in intellectual property and smart centers, but I'm not going to cover those today. So what is our world? Well, the GFCI World consists of over 100 now, 108 centers around the world, all competing in various ways. Now, clearly not all of them are global financial centers in the true sense of the word, that they've got breadth and depth across all sorts of areas. But we do have certainly 15 to 25 who are right up there and competing quite hard. And we obviously have a lot of regional centers, some smaller international regional centers, and a lot of specialist centers, particularly in areas like the offshore world. Our look at this boils down to these being effectively the top 25, and I would like to dwell on this slide just a moment. Traditionally, London has normally held the top rank, but it lost it in GFCI 26 and fell to second place to New York. Remember that we're looking here at international as opposed to the size of the center per se. And in this instance, while New York is obviously very sizable, as an international center, it was typically neck and neck with London beating it by a few points. But it fell, London, in the last edition, and it fell even further in this edition. All of the centers have fallen a bit, as you can see here, the red on the far right, as you see the change in their ratings, with the exception really of Geneva, and then you move way down into the index where you see some of the risers. But London and Hong Kong stand out. Hong Kong fell 34 points, and obviously there's some well-publicized issues with Hong Kong, in particular the unrest that's there and the government responses to it. But London fell 31 points, which is a pretty frightening fall. And if this were to keep up in just 2 more editions, London would be significantly below Paris. So some difficulties there. Yes, Larry.
Mike, this is factor-driven research. What are 2 or 3 of the big factors that have driven that downturn, or some of the trends and downturns in all of the cities since the last survey?
Yeah, it's a good point, Larry. It's a double index, really. There's about 130 instrumental factors that we rank and use, and there are quite a variety out there. It typically boils down into 5 rough categories, sort of the business environment, reputations of the center, financial sector development, business environment, and the infrastructure. And as you can tell, in most of those categories, these major centers haven't really altered that much. So a lot of it is on people's perceptions of how financial centers are going in general. That's largely linked to trade. There was a lot of talk, as you know, over the last 12 years about what has finance really got to do with the real economy. Well, what it really has to do is it has to do with trade. And so as people have issues on trade, for example, obviously the Hong Kong unrest and unrest in other parts of China, but also a U.S.-Chinese trade war and Brexit, and you can begin to see that it's the fear over trade that drives the future perceptions of finance. And in the case of the United Kingdom, it is very much a Brexit-driven fall. We have here, of course, an interesting slide of the top 5 centers over time. This is from the beginning of the index. And what you'll notice here is that the Asian centers have risen over that period of time to really be neck and neck with London and New York. This sounds sort of very obvious now, but I can assure you that back in 2007, when I was telling people that on our calculations, Shanghai, Beijing, and Singapore would all be neck and neck with London and New York, I was very much laughed at. And you can see, nevertheless, the strong trend there. Asia has been for the last 20 years effectively where the action is. It's probably here I might just turn, or we'll wind up with a very long presentation on the index, which folks are welcome to grab online and look at in detail and come back with questions during our question session. But just to turn for a moment to the second index, this is the younger index, the Global Green Finance Index. It's a more complicated index because it's looking really at 2 things here. One, it's looking at what we call depth, and then it also looks at quality. So in depth, what we're seeing here is how much does the center sort of walk the talk? Is it really, really green? And you begin to see here, of course, Amsterdam, Luxembourg, Copenhagen, Zurich, Stockholm. All centers, you would, I think, agree with me, are perceived to be green. And as you go into the center, you will find a lot of work going on, green bonds, renewable energy projects, biomass and waste conversion projects. So no difficulty there. Not a lot of particular change in this index over the last 6 months. Fairly solidly there, with London not performing particularly well, seen by many people to be very much a kind of a home for brown industries, and certainly the carbon tracker work that's been done over the last dozen years or so supports this perception that London is a strongly as much of the old or brown economy as it is of the green economy. However, this slide here, looking at the quality of London's work, does rate London very highly, which is good. One would anticipate a fairly sophisticated centre can turn itself to anything, and the professionals in London are clearly capable of doing that. And so London comes out quite well there. The one thing I would point out in this index, though, is the heavy, almost exclusive focus on Europe. Whilst the Chinese have been treating green very seriously, and for quite some time, I hasten to add, we have, in fact, within the edition of GGFI 5, there's a 15-page supplement on China's work on green. Nevertheless, in finance, it's been very much a Western European, not a North American, not a rest of Asia, not a South American or an African thing. One has to ask oneself, is this a sort of a dilettante thing in green? I'll turn then very quickly to two other slides, which I'm sure, Lawrence, you'd like to chat about. A lot of people are asking, what's the most interesting area of green finance? And it's a bit depressing in a lot of ways. You'll see here the three outstanding areas are renewable energy investment, fair enough, sustainable infrastructure finance, fair enough, and green bonds. And green bonds are bonds which really don't tie people down very much. They're much more of a marketing stunt. And then you look here and you look at areas like carbon markets, which were the big salvation for us when they were going to be when they were launched 15 years ago in April 2005 in Europe under the emissions trading scheme, not featuring. And look at all the areas that don't feature: natural capital evaluation, venture capital, green loans, ESG analysis even. So it's a pretty depressing picture there, very narrow-minded. And then over here, when we look at kind of the most impact on green finance, we see three things stand out extraordinarily clearly, but two of them are principally just people caring. So one is very much about awareness of climate change and investor demand, fair enough, but the other bit is policy and regulatory frameworks. And I think this is what distinguishes green finance from other finance. It's intense dependence on the policy and regulatory frameworks, which have been, frankly, quite wobbly over a long period of time. My final look at the results that we've been getting back over the last 6 months is this slide on reputational advantage. So these enormous movements, it's been the most volatile GFCI we've had over the last 14 years. And you'll see here, though, the column on the right indicates where there's a reputational advantage. Now, that sounds like a really good thing. What it actually means is if we had taken the instrumental factors for Stuttgart, which is up here, and we had not told people it was Stuttgart and used the weightings that they'd given it, it would have come in at, well, it did come in at 696, but people were weighting it at 900. So there was a 200 advantage. That was, people were placing Stuttgart way out of where they would have taken it if they didn't know the name of the city. So the ones up here with this reputational advantage are quite likely to fall fairly significantly, so to speak, if people woke up to what they really were and how they really worked. And you'll notice that London is there 16 points over New York, and that means, in fact, that London is potentially wobblier, if you can call it, than New York. Most the ones at the very top, Stuttgart, Qingdao, Wellington, and even Singapore have got some wobbles probably left within them. These are all centers that need effectively to improve the underlying game. Another thing that I know you're interested in the very last slide before we turn to conversation, is FinTech. One of the interesting things on FinTech is in most of our analysis, regulation and human capital bounce around. Regulation is seen as most important, or human capital is seen as most important. Those are typically it. But in the case of FinTech, regulatory frameworks are fifth, which is a pretty intriguing thing. So whilst the industry spends a lot of time talking about its need to engage with regulators, actually looking globally, most people believe that FinTech is doing fine in regulatory approbation or regulatory restrictions are not particularly important. This may, though, be affected by something I've noticed, which is over in Asia, a lot of the FinTech is what I might consider to be innovative, whereas I do tend to find a lot of the Western FinTech is getting over a hurdle which we've put in our own way. So you go to Western FinTech conferences and you frequently see, wow, I was able to open a bank account online. And you're like, well, yeah, you should be able to. In Asia, it's much more creative in applications where they're trying to do new things or to embed finance at a much more detailed level, whereas in the West it does tend to be sort of overcoming regulatory or other barriers placed there either by regulators or by antiquated systems. Anyway, Lawrence, sorry, that was a quick canter through it, but over to you.
Well, that's great. Just before we move on to the C19 part of the agenda, Michael, on this last bit of importance to FinTech, let's just pick this out again. And one of the reasons you think that the regulatory frameworks are fifth rather than second or third, as they appear in many FinTech environments, is broadly the Asian factor, number one, where, look, FinTechs can get bank accounts without an issue, whereas it still is a problem quite often in London, and particularly for blockchain or crypto-oriented firms. But that too, for the most part, would you say that broadly the regulatory hurdles, for example, in anything to do with challenger banking or payment service provision are just actually baked in and normalized into the Western system?
Yeah, it's funny enough. This year I've been having a focus. I am sheriff of the City of London this year, one of two, with my fellow sheriff Christopher Hayward, and our focus has been very much on anti-money laundering. We've been questioning whether or not we can strengthen and simplify it. One of the funny things is if you stand in front of an audience, as I have on a number of occasions, you say, if Britain is open for business, try opening a bank account, and the number of heads that start nodding. So it's very, very baked in, and it's been baked in for some time. There is, in fact, a financial services group task force currently trying to strengthen and simplify it amongst the livery companies in the City of London. So there is activity and people working hard at it. But yeah, it is baked in. And one of the things I find interesting, we had a session last November where I hosted a good acquaintance of mine who's the chairman of a very large Chinese bank. And he was there with a bunch of UK FinTech people who were all trying to explain to him that if he, who had something like 750 million customers, used their FinTech, they could get over regulatory hurdles such as opening an account or transferring money. And he stared at them somewhat nonplussed because none of these issues had anything to do with him, and why he would want FinTech from a country of 65 million which was all a bunch of little startups, really left him quite baffled. So there's a big distinction here, and I think if you go to a lot of Western FinTech conferences, you would think regulation was way up there, and it is in the West. But if you go to FinTech conferences on other continents, it's not so prominent.
Yeah, fascinating. And then just two takeaways about each of the indices. Is it fair to say that the green index, if I'm using it really, is indicating that, look, there's a lot of narrative going on in each of the cities. You need to dig deep for a bit of depth, but fundamentally on issues like carbon, which are coming down the statutory pike at some point or time, actually score low relative to green bonds, which are quite often window dressed. And so that's the important thing to keep an eye on as that index develops.
Yes, we would like to see those areas develop a lot further. If this is just a green bond market, it's a bit flaky, and it does appear at the moment that green bonds are the poster child for that sector. There are some interesting moves, though. There'll be people online who probably feel I'm being a bit harsh on green bonds, but I think that they were a good starting point. My difficulty with green bonds is that they're not really hypothecated. So if I raise funds and get it approved by one of the big four, some of the other certifiers, to say that, for example, I'm going to create a large biomass plant with this money, and everybody agrees that's a green thing to do. Once I've got the cash, if I then think to myself, well, maybe I'll only build a plant half the size or whatever, and I'm going to use the money for something else, there's very little comeback. So it's a nice thing to have, and there's investor demand to claim that it's in green, but nobody wants to look too carefully at how it's all put together. The contrary to that, which is very encouraging, is in the last 18 months there have been quite a number of, they've got different names, but bonds that are called, I've called them for many years policy performance bonds. So Enel, Nokia, Louis Dreyfus, Danone, these are companies that have actually said, no, what we'll do is we'll pay an interest rate based on the degree to which we achieve our target. So if we set, for example, a target that we're going to reduce carbon emissions by 20% and we only reduce them by 10%, the bond will pay 10% interest. These are exciting. There are about 10 of them out there now. They're very recent, the last 18 months, as I say. And of course, one of the things I'd love to see is to see a government issue a policy performance bond like that.
Well, we're going to have to do an entirely separate session on policy performance bonds and our mutual focus on green, no question about it. And then just lastly on the Global Financial Center Index, the key takeaway for the audience is, look, outside of all of the important factors, including the top 5 that you mentioned, what to keep your eye on is trade here, because that is really driving reputation, not particularly that you've got a big banking center, but it's that you're a center for finance. And, back to your prediction a few years back and saying, look, you're going to see a lot of these global centers converge. That is predominantly driven by global trade. Is that really the best sort of single takeaway to take away from the GFCI?
I think it is. When I'm looking at financial centers at a global level, I tend to, personally, I divide them on a number of axes. So one axis is wholesale and retail. And a lot of people spend time, but there's very little, I think, of the global financial center at the retail level. That's being done MasterCard, Visa, Alipay, Tencent. So to me, the financial centers we tend to focus on are up at the wholesale level. And they divide into 2 areas. Now, people talk about trading and some of the underlying markets, and those are all very important, I accept, but they are, to some degree, decentralized. And the physical location of trading in Milan or London on shares is almost irrelevant. But where they do divide is trade, as you indicate, is one huge driver. When I talk about Big Bang here in London in '86, people tend to think it was all about the trading on the stock exchange. Well, maybe, but I often point that one of the biggest moves was after 7 years of waiting for exchange control deregulation. So in the United Kingdom, we had exchange controls up until October '79. And it was in 1986 that Citi moved its entire FX processing to Deptford. And that was far more jobs in one go than anything that was being done in the city on share trading. So trade does drive a huge chunk. And the other chunk, of course, is where the international deal's being done. And that drives the accountancy and the legal and the specialist consultancy sectors. And one of the things one of the reasons people in New York get a bit agitated is when I try and point out to them, I've seen deals done in London or Singapore or Hong Kong over the years, many, that haven't had a domestic component. So, for example, a French, U.S., and an Indian pharmaceutical doing a deal in London. No trouble. But I've never seen a deal done in New York that didn't have a U.S. domestic component. People do not go to New York out of choice. They go because they have to, whereas these other centers have historically had that huge M&A and transaction-driven work. So those would be the 2 areas I'd talk about.
Great. Let's move on to COVID-19 and the coronavirus. We've seen over the past week governments and central banks focused on fiscal and monetary policy to help businesses, central banks getting interest rates down to 0, and offering really to print money to help solve this crisis. And as you and I were discussing last week, this is a health crisis. It isn't a financial crisis, but it's a health crisis now that is turning into a financial crisis and a potential crisis for humanity. And so, what is your broad view of the implications for the economy as we sit here 3 or 4 weeks into the West into this crisis?
Well, yeah. Well, first, one obviously has to point out it is a medical and a human crisis, and people are genuinely dying. And sometimes when you sit at home on your own, you kind of lose touch with that. So it's a very real crisis at that level. The economic implications of it are fairly stark, and basically we've decided to shut large chunks of the economy for several months. And this, I think, leads us into some interesting questions. Are these things that people should have seen? So if we'd shut the economy for a day, I don't think anybody would be talking about compensating people. So this is clearly seen as something that's unusual enough to justify a very different set of measures. Now, this, I think, leads us into some interesting bits here, more on the area of monetary theory. If you ever wanted a test for modern monetary theory, this might well be it. The idea of helicoptering money is broadly what we're doing. We're doing it in a number of different ways around the planet. Nobody's quite grasped the glory of Milton Friedman, who originally proposed the idea of helicoptering money. He was really going to drop it directly into people's pockets. We're at the moment trying to save firms, and I think that's going to cause a lot of stress for a variety of reasons. Firstly, some firms won't do that badly. Other firms will do extremely poorly. The firms that do poorly will be up front, obviously restaurants, catering, all of that, airlines, travel. And so the question then becomes, do governments save them kind of as they begin to fail and basically respond, or does the government try and develop a blanket program? Now, I'm not criticizing governments because this is happening so fast. This isn't if I was in charge, I'd know what to do. But some of the things that have been going on, like the furloughing here in the United Kingdom, have been actually very bold moves and potentially quite good moves, that people are reacting very rapidly and realizing that this will go through the economy at a rate of knots. As we move back from it, though, you're already seeing, I think INET had an editorial last week immediately sort of saying, how are these people going to pay it back? And if we've saved private businesses, then surely the taxpayer should have a control of them, should be getting some kind of proportion back from it, should it have equity stakes. So we're going to see a lot of, I think, discussion about the role of business in the economy and whether or not it's subservient to the state. At the moment, with these massive state interventions, $330 billion here, and only due to rise, I can see a lot of discussion in future that maybe everything in the economy is actually there to be subservient to the state, which has not been the way that we've looked at things in the past.
It's a very good point. Tracy Alloway at CNBC tweeted last week something which really twigged with me earlier in the week, which is that the financial system is just not set up for a temporary forbearance of payment. On the basis that if you don't pay someone something, then someone else is owed something. And this is part of what I think we're having to deal with. And I think your point about, Friedman's focus on putting money in people's pockets rather than bailing out business has certainly been one of the larger threads in any of my discussions. So how has the recent announcement from the UK Chancellor gone down in the city and the business community?
Well, it's a remote city. I can only talk about the phone calls I've had. I can't actually say I was wandering around the pubs and bars of London or in meetings with people. It's gone down, I think, extremely well.
I hope not given lockdown. Yes, indeed.
Yeah, I think it's gone down extremely well. The point is he recognizes that this is bold. I mean, this calls into question the whole role of credit in a modern economy. That's the big thing that's going on. We suddenly realize we just don't have enough credit in the system to take a 3-month hiatus. And we just never faced anything like that before. Now, when we come out of it, does that mean that we should have 3 months or 6 months or a year's worth of reserves at all points? What does that mean? And are we going to be able to restart things? I remember giving a lecture, it was about 16 years ago, on trying to get the Iraq economy going again. And so with all the things that we knew, with all the money that was pouring into Iraq, we never succeeded in getting that economy going again. And so here were a bunch of Westerners over in the Middle East having shut the country down, unable to restart it. And you look back at that, and it's pretty depressing. An economy with a population, I think, something close to California, and we were unable to get it moving. And our presumption at the moment is once we lift the restrictions, this will all just kind of go back to normal. I wonder if that's true.
Yes, and I think when governments say whatever it takes to save our economy, and that seems to be a common thread with governments and central banks in many of the markets. But do you think actually that the financial markets are convinced by this response? I know the U.S. markets have popped back a bit and had some of the best gains over the first few days of this week, given the $2 trillion announcement in the U.S. But do you think that's temporary, or is there really something in the markets believing that the governments, can do whatever it takes to sustain things?
Well, certainly these moves and the rhetoric has all been geared towards the idea that the governments will do what it takes. The problem then becomes, well, if government does what it takes, and there are several other setbacks. So, for example, restrictions are released, virus comes back, restrictions are reapplied, and we sort of have a very, very bouncy landing. During the course of that, we're lengthening the period of time where people are looking to what the government is saying or doing, at which point you begin to think to yourself, well, aren't we just all working for the state? So how relevant are the financial markets? If this starts to eat into areas like pensions, so am I more dependent on the government for my future pension, or am I dependent on the government to prop up the share prices of the things that are in my pension portfolio? You begin to see some real confusion here. And the length of time that this goes on is going to be, it's sort of a truism, obviously, but it is going to be very important to how strong or how weakly the government is seen to be the long-term arbiter of value.
Well, and I think that's an excellent point. I think it's one thing that there's a temporary economic delay due to a health crisis that everyone's focused on solving versus a long-term impact to your own personal balance sheet, your pension, whether it's your values, or burning through your own savings or cash estate in order to get through a global crisis. So this is exactly where the tussle seems to be. And Michael, if we were looking, I don't think we need to cast a net globally, but if we were focusing certainly on Europe or in the Western economies, have there been particular announcements from either governments or central banks that you've honed in on and thought, well, that's pretty progressive. That's helping to serve Milton Friedman's helicopter money principle, or something that you might want to consider the UK government to pick up?
It's an excellent question. As you look at policy responses around the world, there have been some really amazing ones amounting to several percentage points of GDP. I would contrast, for example, South Korea, which has had arguably one of the smaller, I think it's just around the 1% of GDP mark, has been its policy response. But of course, it also has one of the better results in terms of keeping it under control. The U.S., on the other hand, some of the announcements could be seen to be something like up to about 10% of GDP. So wild changes there. Within Europe, I've been particularly struck by Germany, a very considered response amounting to just under 4% of GDP, whilst which is actually larger than what the UK has been talking about, and done, I think, in quite a structured way through their Kurzarbeit, which is a long-standing program they have on working hours and short working. So Germany, actually, it was probably one of the better prepared of the larger economies to make an announcement. Seemed to have made a very good one.
Let's move on.
Oh, sorry.
Go ahead. No, go ahead, Michael.
No, I was just looking. Oddly, this leads, I think, into one of the questions that popped up from the audience. What do you think about governments using a digitized form of self-liquidating stamp script as used in the Great Depression to cure virus-infected economies? I love the question. It's a good one. It's interesting there. There have been a lot of discussions around. I know Peter Randall over at Settle has been trying to push for some kind of helicoptered money using types of stamp script. Shan Turnbull's also been very active. People who've been talking about this, I think, have got a point. Unfortunately, it's probably at least as tied up with identity systems as anything else. So, in America, a lot of the talk has been to issue via the IRS, the Internal Revenue Service, principally because they know where you are and they can get their checks to you. In the UK, it's a little bit more confusing how you would issue checks to everybody, again, possibly through HMRC. But I can see a lot of people making an argument that what we ought to do is institute an identity system, or at least bribe people to take an identity number of some form and use that identity number to drop the money on them. And then this, in turn, has led to people proposing that this might be a good way to introduce central bank digital currencies or digital fiat currencies, depending on the terminology you like. And again, a lot of rubric around that. So it's an opportunity potentially for some innovation. If the UK were to get out of this with an identity structure, maybe not a card. I'm not a big fan of a particular card, but an identity infrastructure that it could use, and make an experiment towards digital fiat currency, it could be an upside to all this, and allow a number of other things, particularly coming out of this in areas where we might need things like an actual deflationary currency or ways of controlling inflation in the future. So there's potential here, and governments are making some bold moves, at least at the fiscal redistribution level. Will they take that into the technology level? They have a habit of getting their fingers burned, but it is an interesting idea.
Well, full disclosure, leading advocacy in my camp on looking at the role that digital assets have to play in this crisis. One side of it says, look, it's just a bit too early for central bank digital currencies because we've not quite baked the cake yet, and I accept that. And so I think we've put the industry on notice that they're of service to the government if we can work with any governments to help solve some of that. But I remind everyone that we do have cryptocurrencies and stable coins in place right now, and there are vehicles if we did need to get to government quickly, get government money to the public quickly. And I like your hack, which is, look, we rather than sit down and try to solve the total identity crisis, it doesn't seem overly complex to me if we need to shut everything down in a few days, that we can get folks from the community together and get everything running to get payments to people quicker.
Mm. Well, I think it's kind of pressing in a lot of ways, because if you look at the previous crises that we faced where this sort of intervention was required, it was back in 2008 during a series of crises, 7, 8, and 9. And finance was very much the problem, and the solution was to put things into finance. What I'm a little bit wary of, and I think people in financial services coming out of this might want to ponder this, we failed to apologize for those crises. We failed to really reform ourselves. Quantitative easing was largely recapitalizing our banks, who never really made it onto the high street or the main street. So that was that. We just kind of shrugged our shoulders and left things largely as they were. This crisis, governments have pretty much decided not to use the financial services industry to solve it. They haven't been talking about that at all. The distributions in the UK through the British Business Bank and things like that mean that they don't really see finance as part of the solution. And that's pretty scary, because finance is supposed to be one of society's great problem-solving mechanisms. This is how we're supposed to redistribute resources. It's how we're supposed to indicate where the future lies, where the planning is. And if all of this is now coming as government saying, well, we don't really need that system to solve this type of a crisis, coming out of it, I think there'll be a lot more discussion about what is the role of finance, what is the usefulness of it.
Well, you make a case for rebooting the financial services sector. So, I mean, carrying on with that, what do you think of the major implication for London, for the financial services sector, not just the banks, the insurance sectors? How are we going to fare through this?
Well, I'm glad you mentioned insurance. I mean, insurers at the moment, at least the headlines are that they're running for the hills. I've certainly seen genuine cases brought to me over the last few weeks of insurers saying that, well, because COVID-19 wasn't something that they were aware of, it therefore didn't constitute a pandemic as covered under the business interruption policies, et cetera. My clients are fighting these things, and I think that they've got every reason to succeed, but that's hardly the way that a responsible industry handles a crisis, which is just to deny that it's got any cover when it wrote the policies. So I'm kind of wary about the way that that's going, and a few more incidents like that, and you'll begin to see calls for a government insurer as opposed to who needs a private insurer who runs for the hills. The minute there's a problem, it ought to be a government insurance package. And we saw this before on terrorism when the market dried up after the terrorist incidents in 1992 in the United Kingdom. We created Pool Re here, which is a response to pretty much bring back an insurance sector. And the industry has to deliver. We can't always be running when this goes on. And then we're going to turn into other areas as well, which is finance is highly correlated, I think, in most people's minds with inequality. And you're beginning to see, wait a minute, our brave boys and girls on the front lines of the NHS, is that far more important than the head of an insurance or a banking company? Somebody who's actually saving real people's lives. And I don't think we're making those arguments of, why this is important and what we're doing. And at the moment, we're not shining. So I'd like to see a little bit more, what are we going to do as an industry to help out, or are we just going to hunker down until the government solves it, and then we'll come back and say, oh, we'd like our cut of the pie again?
It's one of the best rallying cries for rebooting financial services I've ever heard, Michael. Excellent. What industries are going to benefit from COVID-19? So we've seen the temporary intervention of manufacturers now focusing on making oxygen machines. But are there any true longer-term winners that you can see coming out of this crisis?
Oh, well, that's speculation, but I guess that's why we have these kinds of webinars. Certainly we've been chatting, and I remember a number of us talking several weeks ago about buying shares in Netflix and all of that. Now, I'm not offering any advice. Things are going down as well as up, and up as well as down, et cetera, et cetera. But I do think there are a couple of things. One is this could be a tipping point for home working. It could be a tipping point for video conferencing. I think everybody can see that. But what that possibly means, though, is the next order down is what that does to commercial property prices, which could plummet. But also, as people are cooped up at home, I could see a tremendous amount of, I could really use a little bit more space here. And so a huge pressure on domestic. So possibly domestic and residential prices rising quite markedly, and possibly commercial properties dropping quite markedly is sort of one thing I think you could look at out of industry. I think the other thing to think about is the buffering. We're seeing in this system we don't have enough buffers, and a couple of things like topping up of the strategic oil reserve in America, but topping up, say, for example, food security in Britain. A lot of pressure, more upwards pressure on warehousing, more upwards pressure on van deliveries and things like that, which I think could again accelerate a move towards more online and a depression of retail and a depression of the high street.
Well, that last point, in particular, food security and the food supply chain has been a big topic in my own community, in that I was accused of saying we need to keep an eye on inflation. People were thinking I was talking economic or wage inflation. I was talking around really the inflation of either devaluing currencies, but problems in the food supply chain. And again, this whole idea of buffering, I think, is just such a great introduction on a webinar like this, because people don't seem to be thinking about the provisioning or redesigning some of the effective mechanisms in things like the food supply chain that are probably going to be important for tomorrow.
Yeah, I always look at the systems in the round, and it's kind of a question you ask yourself. It's maybe not the first question, but how much fat do you need in the system? And people can be too thin and people can be too fat, but but fat exists for a reason. It's there as a reserve. It's there to hold things back. And so I see a great correlation between the amount of fat you need in a logistics system and the amount of fat you need in the financial system. That's what credit is. Credit is fat.
Let's get on to some of the questions. I have to say we've done a reasonably good job of getting through most of the questions. This one is the C-19 crisis seems to be underscoring the every country for itself mentality, which lends itself to the question, is the EU viable in the long run? Could this be net positive for London, UK companies, or FinTechs?
Yeah, this seems like a slippery slope to a Brexit answer or an anti-Brexit answer. Oddly, I would argue more the opposite. Here in the UK, we've been operating largely on our own. Europe has shown a reasonable amount of solidarity, particularly at the ECB level. This could potentially pull Europe together even more. Looking ahead, though, in a much more positive fashion, I think there's some opportunities here to start creating funds and a lot of transnational entities that would help hold things together. But to be kind of an isolated outpost, not participating in what everybody else is solving jointly, wouldn't be a good position to be in any event. So if we start to see some, a good example here might be to think about the catastrophe bonds, the pandemic bonds that were out there. They've got sort of two levels of press. The Guardian level of the press is, oh my gosh, these pandemic bonds are useless, and they only pay out when there's a pandemic. Isn't that terrible? People making money out of it. Well, actually, that's not true at all. It's the exact opposite. The people lost money on it. That's exactly what they were there for, was to be triggered in the event of a pandemic, and then those monies were available to countries to spend. Now, the scale of those bonds was not really sufficient to do very much. But going forward, I could see, for example, European pandemic bonds and pandemic structures allowing people to have drawdown facilities much earlier in any future crisis to tone it down. Will Britain participate in that or not? And I would think it'd be a great thing to participate in it. This is any kind of risk distribution is what you want to weather crises in the future. So I'd like to see that sort of attitude.
Yes, it's a great point in that some people seem to have forgotten the benefits of that risk distribution in integrated trading economies, but we'll put that one aside. I've got one more question, which isn't a question. It's, I think, a best practice hint for us, which I'll read out before getting to you with one last question, Michael. And this reads, Australia has solved the identity problem by providing every Australian aged 14 or over a secured account with the federal government, and all dividend or interest payments in any Australian accounts are automatically reported to the tax office. This means individuals living only in investment income do not need to prepare a tax return, except to confirm that no other sources of income, I guess, have occurred. Thank you for the submission on that. I'd certainly encourage people to look at the Scandinavian countries where, again, through a national identity scheme, your bank account and your tax records are linked. So there are countries that do this. The question is, can we find things in the UK or in the US to get money to people quicker, which is what I would focus everyone on, particularly in the financial services sector. Sorry. And then, Michael, just to wrap up, what do the next few months have in store for us, and how's London going to come out of the crisis?
Well, the longer this continues, the tougher it will get for London, because at the moment people are not, wholesale finance is not high on their list of things to do. With travel highly impacted and the traditional way of handling mergers and acquisitions being face-to-face meetings and things like that, expect to see a big drop in M&A work. Expect, as you indicated, I think, Lawrence, that it'll be the government announcements that'll be driving the markets. We've even seen indications that perhaps firms shouldn't have to report their earnings and results as early as they usually did. So we can see, I think, financial services in a dangerous holding position for a number of months. I'm personally quite optimistic about London vis-a-vis other centres, despite the index showing we may have taken a little bit of a hit. I'm actually pretty bullish about London per se. It's probably more the role of global finance I'm concerned about. And, you know, if you were to muse on sort of one kind of final thing, as we go through this whole crisis, we're beginning to realize that an enormous slowdown in the economy, a tax system that is very antiquated and complicated, I could see some potentially huge shifts in the way in which we handle taxation. So I've long been a proponent of a serious examination of land value taxes, and I noticed the comment there about Australia and the tax system and how that works. Imagine if we decided we would really do away with income tax, move into sort of land value tax. Problem is we'll probably wind up moving into a wealth tax, which isn't a land value tax per se. And I can see a lot of discussion over the next 2 or 3 years about how society wants to reorganize itself. And that'll have huge implications, again, on financial services, much of which is built around trying to, you know, minimize the tax implications or the bad decisions that might flow from bad tax application in the real economy. So huge amounts of change ahead in how we're going to handle things. And you can see that just looking at the various announcements I get every day from law firms and accountancy firms on what the latest government pre-announcement was from the Chancellor on, you know, furlough applications, applications for deferral, VAT, etc. So we're going to see a huge amount of complexity coming out, and I wonder if somebody's going to wake up and say, hey, there must be a simpler way to do this.
Well, I love that, and if we can balance the land tax with the consumption tax for most people, which says that Milton Friedman's policy will work, and you know I'm going to get paid to stay at home to make my contribution to the economy, as well as in a green way only get taxed for my consumption, we might start to move some of the bigger carbon or plastic, you know, disasters that we're looking at in the community. And listen, Michael, just one last thing, and leaving on a high note again. What is one of the the best things that you've seen out of this crisis that you've focused on?
Best things out of this crisis in a financial services aspect, Lawrence?
In any aspect. Mine's having to homeschool my daughter, which has definitely been hugely challenging but rewarding.
I think, you know, this is a very selfish thing. My kids are out of school, so I probably have it easier. I guess the biggest thing has been just this, finally people waking up to the potential of technology and travel and working from home and video conferencing. I know it's silly, I know it's obvious, but as a long-term environmentalist, it's been great to see people waking up. I have a regular meeting with about 20 other people and a half for the last 7 or 8 years, and we decided to hold the last few of them online for obvious reasons. And I've got people my own age going, hey, wow, this stuff works. Hey, why can't I mute my screen, or can't I blur my, oh, I can blur my background. Oh, that's phenomenal. And I'm sitting there going, for 20 years, reading this stuff in magazines and airports and, you know, flights and business mags, and you never bothered to try it. But they are trying it, and that's fantastic. And so I've got a lot of upside, I think, for this.
I love it. Professor Michael Mainelli, it is always a pleasure to speak to you, hang out with you, get your outstanding insights to what's going on. I'd like to thank you very much for your time today. And that concludes our first Global Leaders Town Hall webinar. The next webinar is going to take place on the 7th of April when New York State Assembly member Clyde Vanell will be giving us an update, and that will be chaired by GDF board member and GBBC CEO Sandra Rowe. So thank you, Michael, thank you, Emma, and thank you to all of our participants today.
Thank you, Lawrence. Thank you, Emma.